Thank you very much. Good morning to everyone that I met last night at the dinner. It was a great dinner. And to all the other people that I don't know that I'm meeting, you can see me. I can't see all of you or get your names, but it's great to meet all of you. Blockchain is quite a difficult topic to talk about in half an hour, because I've got half an hour, right? And I'm going to try and cover where we are with blockchain. I'm going to talk a little bit about digital asset taxonomy, because there's still a few principles that a lot of people don't fully understand when it comes to blockchain. And blockchain is merely a subdivision of distributed ledger technologies. Distributed ledger technologies is decentralized, distributed, can be private, public, permissioned, or permissionless. And the consensus mechanisms on these blockchains are driven by the protocol that you choose. Sorry, this is just a very quick overview. And if you look at the research report in Africa that we released earlier this year with CVVC, there was a more than 600% growth in VC funding for blockchains compared to the growth in normal VC funding. And those businesses are not only crypto. And the complexity of blockchain, why a lot of people struggle with it, is because some banks are using private permissioned blockchains to solve problems for their existing customers or to move existing businesses onto the blockchain, like what we did with legacy technology for many years. We moved from manual banking to what we believed to be digital banking. I was part of that journey. When I was a student, I used to work in Standard Bank, and I had to fill in the withdrawal and deposit forms for the customers. I was working at inquiries, and then those things were captured. And we wrote it. Before that, we actually wrote the ledger down in a book, debits and credits and entries, and it was signed by 2 people. And we had checks in the banking sector, and it was signed by 2 people. If you look at it, back at it today, that is a terrible system. Lots of fraud is possible, if coercion, if there's only 2 people signing a check. That moved on to putting everything we did, like we did it, onto computers, right? And then later you had all these legacy systems that was developed to solve different parts of the value chain. So what we're very good at, specifically in the banking industry, is we buy a system to do our accounting, we buy a system to do our risk management, we buy a system to do regulatory reporting, and then we book the underlying transactions on a core banking or trading system. And then we send all those transactions to the reconciling systems, because we still believe in segregation of duties, even if it comes to technology, which totally doesn't make sense, because you're replicating the data over and over and over. You get extremely high speeds, but transactions today on average are still touched in a bank by at least 14 people. And that's to get the reports to the regulators, that's tax, that's accounting. So we have split the value chain, and we pay license fees for every single system. And then we all buy Excel on top of that to manage all those systems and to integrate them. So it's quite complex today. If you look at the financial systems across Africa and across the world, I visited the biggest banks in the world, and even though they say they're digital, their systems looks exactly the same as ours. I would spend a big part of my career in treasury, global markets, derivatives, that's your corporate investment banking. And if you look at, I attended a conference after the credit crunch in 2010 in London with all the big major banks, and that's when Basel started looking at risk data aggregation and to make sure that we're picking up our risks in real time, not only once or twice a day. But if you're in Treasury today, they said then, in 2010, you shouldn't be trading derivatives or any financial instrument in trading if you cannot look at your transactions at least every 2 minutes. Do you hear what I'm saying to you? That's the minimum. It should be less. Information should be available in real time to manage your positions, your currency risks. If you look at what happened in the credit crunch, and if you look at cryptocurrency today, And digital assets, it's exactly where derivatives and financial instruments was about 25 years ago. We went through a similar process, and I'm very happy to say that cryptocurrency is now going to be accounted for in a similar way as financial instruments at fair value, and that makes perfect sense. Okay, so that was just the introduction. And now we're going to go through the presentation. I just want to show, and I'm not going to talk about how to implement blockchain. Because blockchain doesn't work, it's open source technology. That's a concept that lots of people don't understand. That means it's not one company building the technology with an IT service provider, but lots of developers collaborating to build a solution for everyone. So that's very difficult for corporates, banks, and centralized organizations to understand. The underlying principle of a blockchain is a decentralized capability, which means every transaction doesn't have to go through a central authority. That's very difficult for people to understand. And the fact that you don't have, Microsoft's got like a quantum ledger or something, I looked at it, but it's still on a central database, one database. And a lot of people believe if you put things on the cloud, it's decentralized. It's not. If you look at the distributed ledgers, we joined the Adira Council. They've got 30 council members, so 30 nodes. It's not as decentralized as the other public blockchains, but they don't like it if two customers store their node on the same cloud. So if one of the guys uses AWS and another guy uses Azure, then every single member that gets added on must be on a different cloud. So I said all these things because what blockchain represents in the world is a paradigm shift. You can see there's a disruption when things become proactive, similar to the Industrial Revolution. What we're doing today is we're booking transactions on source systems, even our mobile transactions, and then we reconcile it retrospectively. So if we're all very honest, we've, over the years, digitized the user interfaces, the front office. But we kept the other operations virtually the same. We put lots of it on technology, but you still need for every business unit a CFO. Sorry, I don't have anything, I was a CFO. But then under that CFO, you've got teams of people that does reconciliations. We've got all this automated system, so it doesn't make a lot of sense. And even if you look at the architecture of some of the accounting systems, banks today buy account payable ledgers and they buy account receivable ledgers. But accounts payable and receivable can be one ledger. So that's the kind of efficiencies. If you go and drill down to all the things we're doing today, there's huge industries linked to ensure that we can trust the data by aggregating it and then checking it on a ledger. And then auditors comes twice a year to check a sample, and then you will still look, you get post-balance sheet events. If you go and look at all the big banks today, across the world, there's post-balance sheet events. It's stuff we missed. A dollar open position. People thought it was booked in local currency. It was 20 million. I'm going to use Nigeria, not because it happened there, but say people thought it was 20 million naira, but it was $20 million that wasn't revalued by the system. That's huge foreign exchange exposure. If the Forex goes against, it can impact your results significantly. So that's the level. The world's moved to transactional, and everybody knows about data and data monetization. It's critical to be able to monetize data as it happens. If you look at a beer company, if you can track every 30 minutes across the African continent what types of beer people drink, you can see they drink Heineken at 9 o'clock in Nigeria, they drink this there. Can you imagine the power of that? And to analyze in real time what people are actually doing. It's a terrible example, beer, but there's lots of other examples that you can look at as well. And blockchain and distributed ledger is a new state. Today, the state, the ledger, is owned by multiple private companies that gets immense value from the fact that everybody's got a ledger, Banks prove by having a ledger that digital payments, you can't do double payments. Because if you digitize something, if you think about email, it means you can send an email to someone, but you can send that same email to someone else, right? A blockchain is exactly the same. It's an internet, it's Web3. People talk about Web3. Web3 is the ability to own digital or stuff in the digital world, like a Bitcoin, non-fungible token. That's added to the read and write. So there's lots of presentations now about Web 1, Web 2, Web 3. Web 1 democratized information, Google, so you didn't need encyclopedias anymore. Web and communication, your emails. Gideon and I spoke about it yesterday. He did a call on WhatsApp with someone in America. When I was young, it would have been 2,000 rand to do that call because it was fixed landlines. And 20 years ago, no one would have known, not even our customers, that we're going to be so big on mobile banking today. And similarly, in the next 10 years, no one knows, not even our customers, that customers will not join a bank if they don't give them payments for free. Because that's what the new blockchains can do. So I'm using Adira as an example. That it costs you 1,000th of an American cent to do a transaction on Adira. You can Google it. And it's not like blockchain. It's carbon neutral. It doesn't use a lot of energy. And it's governed at 10,000 transactions per second. Algorand, here at UCT, can do 100,000 transactions per second. That's what we call next generation blockchains. So it solved the trilemma that we had in the past of security, speed, and cost. So it solves all those things. It's extremely secure. The way the Adira Hashgraph consensus mechanism is set up is for speed and 100% security. It eliminates risk. So people don't believe that. But if you look at how this thing works, it's the only blockchain that got a recognition from a university that their protocols are extremely safe. So this is where the world's moved in the last 4 years. I've been in blockchain 4 years ago, and I can honestly say to you when I started, what's happening today, forget about crypto. Crypto is like 1% of blockchain. It was the first POC on distributed ledger to show you that you can function in a trustless environment. Banks are there to bring trust. But what if you get ecosystems now that provides the ability of a whole community to validate transactions? If you bring transparency on one ledger that's seen by everybody, we had a nice discussion last night. Can you imagine if you can see every municipality in the world's income and expense analysis on a ledger every day? And you can link it to their budgets. They got $1 billion to fix, to provide water. Then you can analyze the billion and see how much of that billion is paid on salaries, how much on infrastructure, maintenance, and to fix the stuff. That's fantastic information for people that need to vote, for people that need to run their resources, public goods. So that governance is what a blockchain brings. But there is a lot of resistance because people don't want transparency. A lot of senior people don't want transparency in real time. They want to massage the numbers before it goes out, right? But as a chartered accountant, I'm not allowed to massage numbers. But that's how the world works today. So that is the things that's slowing the implementation of blockchain down. It's fear, and people don't know what a blockchain is. People, when I present to people across the world, even at universities, they say to me, but it's very expensive. That's the Bitcoin blockchain. Ethereum's a lot cheaper now because it's got a proof of stake consensus mechanism. But they don't understand that a transaction is peer-to-peer and two people are actually matched. A smart contract handles the inventory. It obtains assets and it distributes assets. That's what people used to do. And that's what Coinbase and the crypto exchanges are doing today. Crypto exchanges doesn't represent blockchain or distributed ledger. Crypto exchanges are like banks. The only problem is FTX went down because they're not as strong as a bank when it comes to capital and insurance. A lot of these crypto exchanges want to give assurance, but they need banks. In this new world, I'm going to show you a taxonomy. The two worlds are starting to blend. You get decentralized finance. I hope what I'm saying makes sense to you guys. And it's not Greek. But then if you combine central finance with decentralized finance, you get open finance. So what that means is, even if things are decentralized, it doesn't make sense, but you still need to regulate it. So that's proven, and what happened to all the exchanges. So if everybody, I don't know if all of you have seen this. This is the hype cycle from Gartner. But you can see, is there a pointer? Oh, shit. No, but if you look there where the blue arrow is, you can see that cryptocurrencies has gone through the trough of disillusionment, and that's now basically starting to create value and to be becoming ubiquitous, so adopted heavily. And that's true for blockchain wallets and decentralized applications. A lot of people also talk about interoperability. I just want to talk about that quickly. Interoperability means that if we issue a bond today in Standard Bank or any bank, it's going to be on a specific system. The US dollar stablecoin runs on 8 protocols. It means it runs on 8 different blockchains. It's on Ethereum, it's on Stellar, Hedera, Algorand, I can't remember the other 4. But that asset trades on different technologies, but regardless of that, you can buy and sell it between the different blockchains, if it makes sense to you. And you can transfer it between the different blockchains seamlessly. So for that to happen in our current banking systems across Africa, it will mean every bank's core banking system needs to be able to transfer things seamlessly at almost the same valuation price to another core banking system. It's impossible. It's very difficult even for banks to integrate the existing systems. And that's what a blockchain does. And it gives you the result in real time. So that's what Gartner says. The other thing that's very important is the state of cryptocurrency. So you can see there which one of the protocols is the leading blockchain, basically. How a blockchain also works is that if you think about a bank, people can't, this is a very important concept. So a blockchain makes its money from transactions per second or total value locked. So that means how many assets are deposited on the blockchain, and then how many transactions do they do per second. Because remember, they charge 1,000th of an American cent for a transaction. That cost is your infrastructure cost. If we're building blockchains in Standard Bank, we can do a cross-border payment with a stable coin at 1,000th of an American cent, which is 16 South African cents. No, it's 1.6 South African. Oh, sorry, it's difficult for me to do calculations when I'm presenting. I can only do one thing at a time. But whether you pay $50 billion or $1, it will cost you 1.6 cents. So I said to Hedera and the guys, we mustn't sell it this way because people just don't believe it. It's too big for them to digest this. It just doesn't make sense. But you must just look at fixed landlines historically. How much did we pay for fixed landlines to make a call? Today you can send a WhatsApp over the internet in real time. So I want to get back to this point. Blockchain is sending files that represent value from one person to the other one. And the blockchains are built so well that you can't do double spending. You can't send a coin to 2 people to two different people. If it goes to the one, it's locked in and the money will go to that guy and you lose your cash is out of your bank. So that's all the things that's built into it. And the other thing that I want to say to you is that you also get different types of blockchains and you get different types of digital assets and tokens. You get the crypto-related. Bitcoin is actually only cryptocurrency, because if you look at the Bitcoin white paper, that was issued to create like a universal medium of exchange to enable the blockchain and the technology to facilitate banking the unbanked. But today, lots of people drive Ferraris that bought Bitcoin, and lots of people went bankrupt. So you could still build all these great use cases on a blockchain. You can put value chains, you can do lots of things with it. But you can see that Ethereum, the number of developers since launch are increasing significantly. And a blockchain, legacy technology, if you want to do something on SAP, you say, I want to do FX Reval, they will say to you, it's $20 million, and they'll build it for you, right? But they only build it for Standard Bank. It's not available to EcoBank. That's also running SAP. On Ethereum, you get lots of developers, similar to the Hyperledger Fabric and Linux. My son's a developer, so that's where you store your code. It's available to everybody. So you're sharing innovation and thinking. That's a huge difference. You can never compete with a team of people if you only one. And sorry, you must just listen to me. I'm telling you a story. It's true, but you don't have to stress about it because we've got a lot of guardians that's protecting the status quo. So it's still very early days, but what this graph shows, it takes the initial phases of the internet. Because remember, blockchain is value on the internet. Web3 is the ability to own and send value, not messages, not to Google, not to participate on social media, but to physically send money utilizing the internet. And the growth of Ethereum users today is aligned with how the internet grew in the initial phases. So it is something that's really happening, and it's happening at pace. It's happening exponentially. But lots of people are not aware of it because we just look at the crypto side of things. So the crypto market develops in cycles, but this is also true for blockchain in general, because if you look at people leaving banks today, senior bankers. I went to Toronto last year. At the blockchain and Bitcoin and Web3 works, 90% of the people is like old credit equity derivative traders from big banks that's now moving into the crypto space. So it's actually bankers that's moving into the crypto space because they can see what's going to happen here. So the crypto market is driven by price, interest, new ideas, startups, and projects. So it follows that if you think about when Bitcoin increased significantly, there's large amounts of capital in Ethereum. Developers want to mine and work on the consensus mechanisms, firstly, to generate the cash, but also they know if they build a lot of functionality on the blockchains, it's going to grow because there's going to be more users. So the purpose of a blockchain is to attract developers, not to attract banks and customers. And the blockchain doesn't work like a normal business model. Bankers always say to me, how are we going to make money? Well, you've got infrastructure that costs you virtually nothing. I don't want to quote the prices of the things we're building in our blockchain team, but compared to legacy, it's 1,000th of the capital outlay. And you're building robust, fast, efficient, secure solutions. Having been an accountant, I can see how you integrate every single process on the blockchain. That paradigm shift is difficult for people. And to not think centrally, we're very happy. When the post office was there in the old days, everybody's happy to go and buy envelopes, stamps, it's a very old example, and go and send the letter, and it took a week. But when the internet happened and it enabled mobile phones was enabled by the internet. Now, payments is next in line. Not only payments, lots of other activities. So this just, I'm not going to go through this because it explains all the different, you get layer 1, layer 2 blockchain. So a lot of the original blockchains like Bitcoin and Ethereum is seen as layer 1. Polygon and new blockchains evolved that enable speed. You're actually working on a layer 2 blockchain that enables you to do fast, speed, secure transactions, but it still links to the layer 1 blockchain. Then there's lots of decentralized applications, gaming, prediction market, storage. Digital identity is huge. We're working with the Banking Association in South Africa on a digital identity solution and the other banks. Video streaming, music, telecoms, messaging, Telegram, there's payments, big. Ripple, I just saw Ripple signed a huge agreement with FMS in Africa that's paying 35 different countries. You said 33 yesterday. So I thought maybe it's you guys, but with a different name. But Ripple is now, so I'm very excited about it. It's going to make payments a lot more efficient. And then asset tokenization, you can hear about. I'm quickly going to run through digital asset taxonomy at the end. I've got a nice presentation on that. How much time do I have still? Okay. If I'm talking Greek, you guys can stop me at any point and I'll stop talking. If you don't follow me, we can stop and you can read the stuff. And then this article is critical. You know what happened with Libra, but CBDCs and cryptocurrency, stablecoins is the future. We're working on an industry stablecoin in South Africa with all the other banks and the JSE, and that's what I mean with collaboration. It's collaboration. Lots of people say consortiums doesn't work, it's clubs. That's not true. We're building blockchains with our customers. It's not like legacy where you create a user interface for your customers, lots of them, you build a loan solution, and then you give it to people. The way you build ecosystems, the way you build communities, the biggest benefit of blockchain is ESG. It's tracking and tracing in real time in a very transparent manner, the utilization and management of water, electricity, carbon credits is huge. I just want to explain a carbon credit blockchain platform to you. If you think about carbon initiatives, there's always projects. So on this one blockchain, if I want to do a solar project to reduce carbon emissions, this blockchain platform, the projects are all listed. You can list all the projects there. And it's got taxonomies for the projects and calculations on how you need to do it. Then, on the same platform, there's the green bonds and the carbon forwards. They can do carbon forwards as well now. But those bonds are issued to fund the project. So in the past, you would have had projects on a project system, and you would have had bonds on a financial instrument system. Now it's on the same platform. And then the projects, as it's funded, you can see the green bonds increasing. Think of a dashboard, but it's the same blockchain, it's the same data. So then the bond is linked to the success of the underlying carbon project. And then what happens is there's IoT devices that measures whether the project is successful. All the IoT device entries or transactions in real time tells you consistently the project promised they're going to reduce carbon emissions with 80. They're now reducing it with 60. So they're under target. Then the blockchain, the smart contract, adjusts the rate on the green bond. Because if the project's underperforming, the funding becomes more expensive. So we used to track these things on other systems based on inputs from other people. Now all these things are on the same platform. And then just to finish it off, there's a reporting capability for regulatory tracking, taxonomy. The global ESG taxonomy is built into that blockchain. So if you take that platform anywhere into Africa, anyone can start a carbon project. They can disintermediate people. They know how to issue bonds. The calculations are done. The links are done. The tracking is done. And then finally the accounting. These blockchains today are linked to accounting systems like Xero, and I forgot the other one, QuickBooks, and they link the blockchains to those systems to do the accounting in real time. So everything is on this one system. But what does it say to you? That auditors and the governors and the regulators all look at this one platform. They see the complete end-to-end picture. The guy that's running the project can do all his accounting and everything on the same ledger, and he can track his efficiencies like everybody else. And then the bond price gets adjusted. And this is a real blockchain I'm talking about. So that will speed up. Imagine if you want to issue carbon credits in Africa. When I used to be in global markets, we had a carbon credit trading desk, then you had the debt guys, different divisions, different systems. You had all these people, and all that information had to be collated, and supply and demand combined to derive prices of the instrument. So that's fantastic. So stablecoins is crypto that's asset-backed. So if you think about the US dollar coin, it's backed by fiat. The stablecoins the bank are working on will be backed with CBDC. So our view is that CBDCs will take quite a long time before they are utilized as an alternative payment or new payment rail. But commercial banks and regulators are working closely together. If you look at the US regulations, they prefer that regulated entities like banks issue stablecoins. And what I like about it is when you go through the CBDC terminology, hybrid CBDCs is the optimal solution. You don't want a government to issue stablecoins on its own. You want the partnership between commercial banks. And today, whether people like it or not, commercial banks are a lot better at managing wallets, KYC, and identity than central banks, right? But if the central bank backed this coin, you can send it cross-border and everybody can be banked. It won't disintermediate banks, but it's going to reduce all the other payments for people that's got access to to devices. Cross-border payments you won't have to do through a bank because you're connecting. If we build a stable coin between Angola, South Africa, Nigeria, a Standard Bank, and we've got all the on and off ramps there, the bank can then tell the regulator, Ian sent rands to Nigeria, it's converted into Naira, and the Naira sits in a collateral account if we want to redeem the coin. Otherwise, the coin can just be sent back for future payments, if it makes sense to you. But if it's like a bearer instrument, like a bond, there's a secondary market. If you want to redeem your coin, you can. So there's a huge benefit to doing that. So that's what people don't fully understand. But that could unlock brand new markets. Then, okay, cool. I'm not going to talk about this because I'm talking quite a lot. And then worldwide, if you look at the growth, I just went to Canada, by the way. I was there last week. 31% of millennials in Canada own crypto. But you now get the alpha generation. Are you guys aware of them? I wasn't. Someone showed me the other day. But the Roblox and all those people. And they're very into tokens. Does anyone here play not TV games, computer games? Games. So that's fantastic metaverses. So the metaverse is now moving rapidly forward. And the metaverse is almost mimicking the gaming world. And I saw someone sent me an article yesterday. Vogue. No. The handbags, the nice ones, Burberry's, has partnered with Roblox to take their... So I was invited to Miami to the Fashionverse launch on a yacht. But look at my dress. I couldn't go. I'm too poor because it's all the very rich models. And the guys invited me for some reason. I don't know why. But I couldn't go onto that boat. It's not... If you know what I mean, it's totally out of my league. So I said to the guy, sorry, I can't make it. Anyway, Brazil, 16%. Nigeria, the fastest growing in the crypto space. Africa, and South Africa is growing. There's 4 million people in South Africa that owns crypto. And they own a lot of crypto. And then there's lots of people that own small amounts of crypto as well. So whenever I speak to people and they, yeah, I do blockchain and crypto, they say, yeah, can you help me? I want to buy crypto. I say, why? It's so low. I say, no, but they know it's going to grow. So it's actually something that's very visible. And you know when I knew Bitcoin was great was when it was listed on the TV and the financial news every night when you always see the rand dollar and you see the markets and the interest rates and then Bitcoin's there as well. That is a big sign that people ignore. So the 4 stages of Bitcoin, when it started, it was a collectible like all the NFTs. In stage 2, it's now becoming a store of value. Lots of people invest in it. Lots of people trade it. And then the 3rd stage, when the price is becoming stable, it could become a medium of exchange. Bitcoin's been with us since 2008. So it's now 14 years. And for 14 years, people said Bitcoin's not going to be there. What I hate is if there's problems in the crypto market, I get lots of emails from lots of people that say, I told you so. But when it grows like 30%, I don't get any emails. Or if someone makes a fantastic announcement like Ripple this morning, it's extremely quiet. No one says, oh, that's a great thing. But anyway, that's the biases. If you study innovation, we're so biased in our thinking, it's very difficult for us to let go of the things that we used to. And that for me, I've been in the bank for 27 years, and since I started working with this, it's as clear as mathematical solutions to me when I look at a boardroom and I talk to people. They just don't believe in it. And the other thing is, if you look at the amount of studying, there's now 2 MSc qualifications launching at the University College of London. I think they're going to launch 2 PhDs in blockchain, and they're going to launch a B degree, and then they have like short courses to enable you to do crypto trading. So my oldest son is studying computer science, and he's going to work with a blockchain company now. He wants to do blockchain coding. So it's happening, and it's paying fantastic. I hope he can buy me a house when he gets a good salary. So globally, the crypto opportunity, 300 million plus customers, $6 billion. And even from a payment perspective, we're talking about payment aggregation. You saw this week what Pick n Pay's done. They're now accepting crypto. And it's a very simple solution, no risk, but they've got access to the people that want to come and pay with their crypto. So it's different customer base. A lot of those guys are still in the existing banks, but they've got a different life outside the banking system. And the metaverse is also going to be that. It's outside, it's an alternative, extended reality. People can meet in the metaverse. When I studied at Stanford 4 years ago, they launched Virbela, which is a virtual campus. So I met people then already in the metaverse. But my avatar was still dark and handsome. And when I arrived at Stanford, everybody said to me, you're so short, we thought you're so tall. You know? So that's the nice thing about an avatar. You get lots of confidence because you create an avatar that you want, that wears the most expensive clothes and drives a Ferrari. That's the practical application of it. So this is just companies accepting crypto, and it shows you how the transactions increased. Microsoft, we work very closely with Microsoft as a bank, and I think lots of banks. And then Tesla also. But there's lots of companies now. This is the last part of the presentation. This is to explain, it's a presentation we put together at the beginning of this year to explain to people, it's all about the blockchain. If you think about all the things that's happening with digital assets today, like custody, order execution management, trading, swaps, non-fungible tokens, what people don't understand, all those things can run on one ledger. You don't need a derivative source system and a bond trading, SAP or Finacle to do core banking. You can run everything on the same system. So if you book products on a blockchain, the lines between wholesale and retail might blur over time. So it's powerful what I'm saying to you. If you democratize bonds, today only the big investors get access to the great bonds for their pensions, or it's big companies. If you put it on a blockchain, you give an individual a chance to also participate in the auctioning process. If you put stable coins out there, today, commercial banks are the only ones that's got access to electronic money, wholesale. If you go to stable coins, corporates, individuals, everybody's got access to digital money. And the nice thing is, all the operations, the FX APIs, the correspondent banking relationships, all those things will have to charge a lot less money. So a blockchain is the platform or the ledger or the state where everything happens, transactions. It's a transactional system. It pre-validates every single transaction. It matches buyers and sellers on a peer-to-peer basis. It validates that the person's real and they exist. In a public permissionless blockchain world, like Bitcoin, there can be very bad actors. In a public permissioned world, where you use the Bitcoin blockchain, but you only allow KYC people to access the network, it can run like a normal financial system if it makes sense to you, just a lot more efficiently. So in the decentralized world, blockchains enable digital assets. So another misconception of people is, in the digital world, your identity will be a token. If you take your phone, I don't have my phone here. In future, your passport, your license, the government's working on putting our licenses on blockchain. I don't know if you know about it, because there's such long waiting periods and there's lots of mismanagement on the licenses. So if the licenses are digitized, then Home Affairs, the auditors, and the person whose identity it is can actually check that this is a valid identity. You can use verifiers like universities to say this is really Ian Putter. But I can go anywhere in the world. I can go from Standard Bank to Nedbank to First National Bank, and I don't have to go through a KYC process. And my passport is always on my phone. And when I need to update it, or my visa to the US, if it's digital, it's a lot easier than physically going and standing in a queue. So you must just think about it that way. This is what this technology actually does. And there's a book written by the Blockchain Research Institute, The Platform of the Future. So the technology where you can run anything on. But what's important to understand is everything's not going to be run on a Bitcoin, Ethereum, Hyperledger. There's lots of blockchains or distributed ledgers. And they will be private, they will be public. All of them will interoperate, and they will bring their strengths to the table. So it's not one system rule them all. If you like this system and it's got the solution that you want, and the open source code is fantastic, you're going to use that. But what happened over the last year, if you look at the regulatory, the publications and everything that happened, if you lift the hood on this decentralized space, there's now regulated DeFi. I alluded to it earlier. That's open finance. That's stable coins. And that's digital assets that's really regulated. We hold capital. If you look at the latest Basel regulations, stable coins are treated this way. Crypto is a financial instrument in South Africa, but that brings lots of controls and requirements if you want to launch a crypto exchange. They're now regulated like financial institutions. If a financial institution provides on and off ramps in any country for crypto, they become, the onus is on them to prove that the coins or the tokens didn't come from a bad actor. So it's heavy. But this is going to drive, what all the protocols guys said to me, is that this will drive adoption, significant adoption. And the decentralized exchanges are actually seen as a lot better than the centralized exchanges. You know, it's decentralized autonomous organizations where you can go and buy and sell cryptocurrency as opposed to going to a specific exchange. So on this platform, if you look at the taxonomy, you get financial instruments. So today, equity and bonds, repos are being put on by big banks on the blockchain. There's lots of news you can read every day. They're putting existing financial instruments on the blockchain. There's smart contract-based platforms. People talk about smart contracts. Ethereum, after Bitcoin came out and it's got smart contracts, so that enables you, like Polygon, you can have decentralized applications. If you think about a bank app on a mobile, that's a centralized application. Does it make sense to you? Because it's owned by Standard Bank. So Web 2, this is a significant point if you think about it. Web 2 says, your platform, your rules. That's Amazon, Standard Bank, Absa, EcoBank. So if I want to do transactions on Standard Bank's platform, I meet their rules, they've got the ledger. Web 3, my identity, my asset. Because there's no central exchange or entity that owns your assets. I sell my asset directly to someone else. I don't need a central authority. And imagine in future if you can put taxes on a blockchain. If you pay your taxes, you can see where it's spent. Does it make sense to you? I told you about that ESG. This is true for everything. So if you look at financial instruments, I said tokenized securities, non-fungible tokens, a lot of people talk about it. I've got art on my phone. One of the artists in South Africa gave me a token, a digital art, so I can show it on my PC. My wife said she's not interested, she wants the real painting. But I've got this thing, maybe one day when I retire it will be worth a lot or nothing. So then you've got decentralized identity. So I told you, anything on a blockchain, anything can be tokenized. Your identity is going to be a token. When I go to Standard Bank and I expose my stuff to them, they don't own my identity like they do today. I can say to them, you can use my identity. It is verified. You're not going to know my address. You're not going to know my name, but you know you can trust me. I want to use that loan. But I can then just digitally log on to the FNB. If I'm not happy, I can get a loan from FNB. I don't have to go through processes. Digital currencies is on the right-hand side. So this gives you a total picture of all the digital assets. So if you look at stable and asset-backed cryptocurrencies, that's stable coins, central bank digital currencies. So a CBDC doesn't have to be on a blockchain. Lots of people say that to me. But if you put it on a blockchain, the scale is unbelievable and accessibility is fantastic. Believe me. And then unbacked cryptocurrencies. This is the big thing. People complain a lot about Ethereum, Bitcoin, all the stuff they're investing in, but that's not asset-backed. Those things has got digital value because of the effort people put in to mine it. It's also got a price because of the efficiencies it brings. And it also has value based on supply and demand. And the other thing is, if you use it as a payment mechanism, you can have fantastic exponential money growth because you can use the tokens over and over and you don't have to physically print money and your monetary policy becomes a lot easier to do. So if you look at, so the unbacked cryptocurrencies is DeFi, and if you look at stablecoins and those things, that's open finance because you can regulate it. For every token you issue, you've got to have a piece of gold or an asset. That's what makes it, and it makes the markets a lot more efficient. And the most important thing is, the future is decentralized exchanges. Today, a few parties are running it. Sorry, I've spoken so long. I went way off my time. So on a blockchain, when you talk about transfer value, people always think it must be money, but that can be a car, it can be. Blockchain will help us to go back to barter. So if I've eaten half of my sandwich and I don't have money to pay for my train, I can sell it to someone else. As long as I cut it in half and it was very hygienic and all those kind of things. But anything's got value. So you could exchange stuff for other stuff. You can exchange value, you can lend value, you can do fully collateralized lending. There's models for that already. You can invest value, you can fund, insure, manage risk. All the insurance companies are looking at blockchain. They see it as a huge opportunity. If you think about your windscreen, you can put the whole depot where they order the windscreens. All the stock can be on blockchain. And it's linked to the premiums and the insurance. Someone paid their premium, they can just drive and they can get a new windscreen. Wipes out all those signatories that you always have. If your insurance claim gets paid out, there's like 60 signatories. So you can put all that on a transparent ledger. All 60 can look at it. If they're not happy, they can stop it, but otherwise it will go. You can analyze value. Fantastic for AI and data, blockchains. And then storing value, obviously the custody capabilities, that's now available. You can manage people's private keys if they want to. You get non-custodial wallets like MetaMask. That's what the whole world wants. Not a central authority, it's a decentralized wallet. It's your own keys, but you can go to banks in future and you can say, please store my keys for me, keep my passwords, and you can store your assets off-chain at a safe entity like a bank. That's happening. And then authenticating identity and value. I told you about the identity solution. We launched as a bank the Adira node. We're actually consenting as a bank on transactions on a blockchain now. And that's the future. And then lastly, it's trading value. I put it separately because transfer and exchanging value doesn't. Trading value is arbitrage and trading between different markets where coins or protocols where coins will be pulled to the same price. Guys, that was everything. I hope you learned something today. I've overspent my time, but that's it. Thank you very much. Is there any questions?
Thank you. Great presentation. So I just need your point of view, maybe some education, because there's a lot of hysteria around crypto, which is linked to blockchain. And I know crypto experts try to separate both. They tell you that the technology is not the coin. So try to separate both, focus on the technology and not the coin.
Yeah.
So what do you perhaps have to say about that going forward in terms of education? How do we make people understand what the advantages of blockchain are so they actually separate that from the coin itself? That's the first question. And second question is, what's your view on the current FTX scandal? Right? How do we avoid that going forward? Bank runs and all
The correct? The second question, the correct? I didn't hear the last part of it.
So the FTX scandal, so how do we prevent that going forward? Seeing that...
oh, FTX?
Yeah.
Okay, cool. Okay, yes. Okay, great. You're not going to stop FTX. It's a centralized exchange. It's a problem. You've got to regulate them more heavily, and you've got to make sure that the liquidity is managed like a bank. They've got an exchange function, and they've got a centralized exchange function. So if you look at all the centralized crypto exchanges, they will have to be subjected to full-on regulation. And they will have to pay the license fees, and they will have to have fit and proper people. It's actually like the JSE. Remember, they're buying and selling, they're market making. That wasn't but it helps the crypto a lot. So that's the only way that you're going to stop it. And I think regulators globally, after FTX and Terra Luna, there's a lot of events that happen during the year, and it shows you that what you see. Also remember, a lot of the things, if you look at crypto exchanges, I don't know because I haven't seen their back office processes, but I assume it's not blockchains where you can see, you track and trace your liquidity and everything in real time. I'm just making an assumption, it might be totally wrong. But the bottom line is you need extremely efficient and competent people to manage the liquidity, the market, and all the other risks. The big thing here is that the guy that's running FTX, like an individual that's got a company, he's made billions, but he's exposing lots of people to risk. You also don't know if all the people on that exchange is KYC'd properly. I don't sound like a blockchain person, but I recognized after 4 years that that market needs to be regulated, and it's going to make it better, actually. That's the first thing. So I answered FTX now. Now I forgot the first question. Oh, blockchain and crypto. So the biggest thing what we've done over the last 4 years, so I evolved significantly in my role. Gideon is here with me. We've got a team. We don't, like I present, I never present like I present today. I present to people that understand the key principles of blockchain before I actually start presenting. As I said to you, you can now get a B degree, you can get an MSc, 2 types of MScs, you can get a master's in blockchain and distributed ledger technology, and you can do 2 or 3 types of PhDs. University of Switzerland, London, Oxford University, Stanford University, everybody's got, it's a multidisciplinary capability that spans multiple disciplines, from maths, economics, tokenomics. There's new fields in blockchain, tokenomics. There's the collateralization, there's the art, the digitization, the tokenization processes. There's the underlying code. There is now auditors globally that audit the smart contract and the transactional code on the blockchain. Real audit firms. And KPMG, PwC, E&Y never wanted to work when we worked with our private permission blockchains. They weren't interested. They said, a private permission blockchain is like building something in the bank, right? There is use cases for it, but it's very narrow, and it's not going to scale. If you go to FNB and you say, I've got a Standard Bank stablecoin, they might accept it for payments to make it seamless, but they're not going to use it, right? They will issue their own coins. And the adoption of the alpha generation is not going to be great on a private permission blockchain, but depending obviously of the use case. There's use cases for everything. Public permission blockchains is now the flavor of the moment. So the world's moved on, and the regulators as well. So, you know, it's very interesting. I spoke at the IMF conference 2 weeks ago, and there were 20 regulators across Africa there. I had fantastic discussions with the governors, actually. And I explained stablecoins, they're very interested. There's sandboxes in Ghana, Kenya, Angola, Namibia. And they recognize that if they do digital assets, the global economy will be more accessible to them, and they will be more accessible to the global economy. Because they can get lots of donor funds are coming in through blockchains and tokens. That's very comfortable for a lot of people. There's a huge institutional demand. So sorry, I'm answering your question indirectly. Across Africa, there's institutional demand for crypto custody. Big institutions want to invest in crypto. Mauritius, crypto is regulated, it's acceptable. So Mauritius could become the hub at this stage. South Africa is moving very quickly. Nigeria is moving very quickly. They've got a retail CBDC, but I think a stable coin is going to be a lot more beneficial to the communities because of the cross-border capabilities and the fact that it's regulated. But when you're in my role in your organization, you've got a position, you've got to be able to link the new world with the old world. You want to build new use cases on a blockchain, right? Remember in the old days you had business analysts. They wrote the whole process down for you, like 60 steps. When you went from one system to another system, and then you built the 60 steps into another system. Maybe you dropped it down to 58 because you recognized that one signature wasn't necessary. Blockchain can take it all to 2 steps or 1 step. Similar to what the intranet and the internet did many years ago for us. It's that reduction. It's the integration of existing value chains, but there's new use cases. You don't have to do things that you used to do. A lot of it can disappear because you can do it on new. It's like when mobile phones, does anyone here still have a post office box? I don't have one anymore. I've got an email, which I never read, so people can't reach me. When you go to your post office box, there's all this spam mail, and it costs you X amount a month. You don't need it. You also don't need a fixed landline. It was terrible for me when I went to a doctor and I didn't put my fixed landline anymore because I didn't have one. I only got a cell phone number. So you must just think about your banking in the same way. And you must see the post office today struggles. Because what's the business case for the post office? So then, yes? So,
we're a short time, but a couple of quick questions. You mentioned just now cross-border payments, and I was going to ask the question around what's your view on how, for example, the likes of Ripple and Stellar will influence the conversation and dialogue, especially in Africa when it comes to cross-border payments? That's our first question. The second question is, how do you think Bitcoin's value will change as it moves from store of value store of value to medium exchange and not the chain? Do you think its value will increase or decrease even more than it is now?
That's $1 million question. So the first question was, are you asking if Stellar and Ripple is good for cross-border payments?
Basically, yeah.
Yeah, I think it's great. If you think about it, it's private permission blockchain, so you only allow specific people onto the blockchain, and the rails are, it's launched, so they've signed this agreement with other people. So I think, given what I've seen, and here in Cape Town, there's a business that's got 4 stable coins on Ripple. They've got dollar, euro, naira, and rand. And it's running. People are using it to send cash across, but it's regulated. They're a financial institution. So I like it. They showed me the collateral. Fantastic. We spoke to them about 7 years ago. I like the way they work because they've got a web-based user interface with multiple participants, like nodes. And then the banks also contribute to the liquidity. So it's almost like an inward-out build. Like you use the strengths of the financial system and the players, and you're building a robust payment mechanism where you can move cash with the I forgot the token, with the Ripple token. And then Stellar, we've had exposure to. It's also a good blockchain. USDC, if you look at Stellar and you look at Ripple and you look at Adira and Algorand, they may be a little bit more efficient and they can do more transactions per second.
I guess the question was...
Yeah,
sorry,
so that's it. But I think it's great solutions.
The question was guessing more around the because we discussed this a couple of days ago around cross-border payments. So my question is more around, can it impact the regulators, the views of the regulators? Because that's the key sort of friction point, isn't it, in terms of cross-border payments? The tech can be done. But
do the regulators buy into the tokens?
Yeah, exactly. And,
yeah.
In politics.
So locally, a stable coin.
In the central banks.
Yeah, you don't actually have to get approval for a stable coin like cryptocurrency because it's a fully backed token that's got fiat collateral that's backing it. If it makes it so, it's actually like physically sending fiat to someone else. So from a cross-border perspective, you can't just go and send cash across borders. You've still got to meet the requirements. You've got to get the regulators on board. But the regulators are getting on board very quickly. The friction is reducing significantly. Great.
Bitcoin value.
Thanks, guys.